to you and the recommendations we give to you. We use high risk premiums of 12% when working out our stock valuations on companies. Elsewhere in the developed world, 6% is a rule of thumb to be used, so we are factoring a lot of risk to our valuations. Secondly, we believe that the UAE Central Bank guaranteeing deposits and also guaranteeing bank bonds and looking at greater provisioning for banks should lead to some stabilisation in credit markets, such as the credit default swaps that we had on the previous slide. Thirdly, a lot of these foreign creditors that owe money to Dubai actually have significant operations here, so it doesn't really make sense for them to not be accommodative on the credit side if Dubai is a hub for their GCC operations. Fourthly, consolidation amongst some of the smaller banks and property players and greater stakes by Abu Dhabi in Dubai companies, as testament by the ABAR transaction buying a 70% stake in Arab Tech at a discount as well. So I think these are all factors that will influence as the year goes on. So some of the lower valuation property companies may actually end up with Abu Dhabi as a major shareholder in order to finance their immediate terms, working capital and whatnot. So something to watch out for. And fifthly, forced evolution, disclosure and transparency that I mentioned earlier. What the Dubai government does have going for it is significant stakes in local companies, and we've just tallied that up, and at current market value they have 59 billion dirhams worth of local stock in listed equities, and that is deriving recurring dividends which will help cash flow. Secondly, of course, our DWAR and whatnot in the unlisted space, utilities, transport, ports and whatnot are also providing cash flow to the Dubai government, which does underwrite some stability in their balance sheet going forward and give us some confidence that they have the liquidity to meet their debt obligations. Okay, so where are we in the UAE economy? Basically, the UAE GDP growth forecast is around 2.5% as a ballpark, following on from last year, just trickle growth of 0.7% consensus. The GDP components, exports through oil are strengthening, some stability in domestic demand based on population growth flattening out during 2010 after last year reductions of anywhere between 6 to 8%. The government spending by Abu Dhabi on a lot of their new projects should continue and really act as a fiscal stimulus to domestic growth. And I just think that with the recent events and lower business confidence, we will see obviously the tighter credit conditions we've also already covered on, but confidence in terms of business here is really at a critical point now where we need a lot of these issues to be resolved in order for people to start hiring again, investing in the region. So I think that in the short term, that's where the risks really lie. There's all the numbers. Basically the key ones here, really inflation's basically not negligible now, which is a good thing. Population should stabilise, and money supply should return over the next 12 months as banks have a little bit more confidence. I have a feeling that number will be revised back down to 4%, but I think bank lending will increase this year compared to last year. So what are the key catalysts for the economy here? How can things become better? Firstly, I think if the comparative advantages are utilised in low-cost labour and petrochemical, so looking into light manufacturing and retail are two areas where if this occurs as investors, we can have a lot more confidence in the outlook for Dubai and the UAE. It is a big trade hub here, Jebel Ali ports in particular, and I think that DP World is an outstanding investment. Thirdly, it is a regional base. Living standards and the liberal nature of living here is a lot different to the other Gulf states. So it does provide some support to companies looking to retain their head offices here. Thirdly, liquidity. So current account balances should be looking a lot better this year with the oil price higher again, which underwrites the fiscal stimulus programs and also liquidity into ADIA. if ADIA did decide to take a greater role in investing in local markets, that would be a big positive catalyst. And fifth, Abu Dhabi's willingness to support Dubai is evident, and does give us some confidence in the future of the debt profile here. So on to corporate profits. I mentioned before, I don't think I read anyone mention corporate profits in November and December last year when all the papers became negative on what's happening here in Dubai. Look, sentiment plays a huge role in stocks, but the other side of the equation is it has to be what relates to corporate profits. And I think that there is good money to be made on these markets by focusing on the companies that are making money. So the top 20 most liquid UAE companies, their profits fell by around 45% to 30th of September last year. So we have seen a lot of earnings stripped out of the local businesses on the property side, on the industrial side, and less so on the banking side. I think the banking sector will catch up in the first 2 quarters of this year. Tighter liquidity and higher interest servicing costs have reduced bottom lines. But on the positive side, the companies have for once been able to examine their cost bases. During the boom years, the top line growth was high, companies just added more workers, added more costs, fixed, variable, and the last 18 months has really given them a chance to review these positions and strip a lot of costs out of the business. A perfect example being DP World. It's actually held its profit margins perhaps 2% below, because it's been able to switch from a fixed to a variable cost base, and similar for Aramex, which is one of our preferred companies. So there is some margin upside heading into this year. We spoke before about how GDP growth is going to pick up, which will support top line growth for these companies. And given that margins are actually in reasonable shape, this should lead to greater earnings over the next 12 months for the outperforming companies. In 2010, the key figure here is the consensus forecast is that net profit for these top companies will rise by 19%. So people like me are forecasting that some of our core companies here will actually grow their earnings this year. And all else equal, a 20% increase in earnings should be matched by a 20% increase in the stock price. So perhaps if there is some more downside risk in these forecasts, and only rise by 10 or 15%, we're still looking at some. In terms of the property sector, that's been the hardest hit by recent events. Really the pockets of value we're looking for here are more the property companies have been able to restructure their business model with a greater focus on recurring service related and maintenance related fees, such as Amar and Amar and Aldar. I think a focus around the GCC and drawing projects from the region rather than being specific to Dubai or even Abu Dhabi is a positive as well. And Arabtech is certainly in that basket. So long term, the property companies on the larger cap ones are certainly our preferred, so Arabtech, Aldar and Amar. Remember that these three are also index stocks here, so if the market's weak, these three are going to be weak. But I think that earnings will eventually come to the fore for these three companies that have a greater market share, a lot of land bank in the region, ongoing projects, and all very well funded at the moment too, particularly Arabtech with Avar's recent purchase into it. And just looking at the Dubai land transactions, you see the trend has been down. There was some stabilisation towards the end of last year, but I think that the property market confidence is still quite negative at this point in time. Although Colliers did put in a report just yesterday saying that in the fourth quarter villa prices were up 7% in Dubai, and they expect some stabilisation despite 26,000 worth of new apartments coming on stream in Dubai over the next 12 months. So I think that in the case of property and property companies, the next quarter or two will be testing in terms of share prices, but then the favourable entry point will occur.